Hello, everybody, and welcome. My name is Jack Fig. I'm the Community Director here at Decarb Connect. For those of you who are new to Decarb Connect, we bring together decision makers from across the most energy intensive sectors to tackle the practical, financial, and technical challenges that exist in the market. Across our event series and our digital platform, we're helping to accelerate the energy carbon management. It's my pleasure to introduce you today to our February webinar, this time in partnership with PhiCap Advisors. In today's discussion, our team of experts will be discussing what strong leadership teams do differently to de-risk growth capital. We'll be hearing from PhiCap Advisors, but we'll also be hearing from Capture 6 as they share first-hand insights regarding their $27.5 million Series A and project funding round last year. Now, before we dive into that, there's just a little bit of housekeeping from myself before I pass over. So during the webinar, please feel free to share any questions you have in the Q&A box below. And do let us know if you'd like to direct any questions to any of the speakers in particular. Please feel free to include your email in that question as well, just in case we don't get time to cover that during the Q&A. The Q&A portion will be at around the final 15 minutes of today's session. Now, before we jump into things, a quick round of introductions are in order. I'd like to first introduce Brian Begley, co-founder and partner at PhiCap Advisors. Jeffrey Slotterback, who's also co-founder and partner at PhiCap Advisors. Thomas Ricciardi, CCO at Capture 6. And finally, Alex Cameron, founder and CEO at Decarb Connect, who will be moderating the discussion today. I'd like to pass over to you, Alex.
Great. Thank you very much, Jack, and welcome to everybody watching live today. Great to see you here in the audience, and also welcome to all of you watching on demand. So let's dig into the substance of this. We've been using, we being Decarb Connect, we being the media in the climate tech space, this phrase of being bankable at Series A more and more frequently and very deliberately. You know, we can see that capital is increasingly selective. Investors are looking harder at the execution risk and not just whether it's great looking, great sounding tech with great ambition. So what we're going to explore today is, what does that really mean in practice? How can teams better prepare for the kind of round they want to have? Where are they falling short? And really getting some ideas of what the strongest leadership teams are doing differently before they raise growth capital. So I'm actually going to kick off first with Brian and Jeff. I'm wondering if you could give us a feel for what are you seeing in the market now, and really what has shifted most in the last year, because I think anyone involved in the ecosystem would say 2025 to 26 has been a year of change. So give us a feel for what is shifting from your perspective. And
thanks, Alex. I'll be brief. I'll let Jeff chime in as always with valuable color. So just off the top, we're a US-based capital and business advisory firm here in Philadelphia, hence the PHI of PhiCap. So our perspective is largely here in the US, but we do have connectivity to companies overseas or outside the US, in North America and overseas. But obviously it's been an interesting year and a half, 2 years in the broader energy transition space. The pendulum continues to swing back and forth here in the US, not solely because of the political climate, but that certainly drives a lot of the momentum or the inhibiting factors here. And what Jeff and I like to focus on are those that are kind of above those factors that are somewhat resilient to any changes in political climate. So we are seeing projects that come back into the fray that have been somewhat put to the side over the last several years, and we've seen others that unfortunately have stepped aside and are trying to reevaluate their process because of the change in climate. And Jeff, be curious on your thoughts as well.
Yeah, I guess a couple strings to pull at. I think one of the biggest shifts, and certainly something that's extremely prevalent today, there's not pools of capital that want to invest in Series A. So the idea of making Series A bankable is kind of on the surface and out of the gate swimming upstream against the current. And so we'll talk about kind of ways to try and compensate against that. But I think as we think about, the team mentality, having a sense of that reality coming in, I think is of critical importance and helps to frame the next steps along that path. This isn't 2021, 22, where I think you probably saw an overreaction and to some extent a greenwashing of anything that had a decarbon appeal. Was kind of just like a bag that the money filled. We've seen kind of, as you would expect in markets, right, the irrational metronome bouncing back to the other side, where there's less, I think, capital that is specifically dedicated to these projects and specifically dedicated to these projects at Series A. And so I think it's on kind of all of us in this space that we're passionate about to make sure that we're speaking to that community and driving and separating why our entity, why our project, why our opportunity is not just exciting, but is viable and needs to happen in this market. Having that kind of leaning in on that sense is of critical importance at this stage.
Okay, well, thank you for that. Let's have a look at, there were sort of 4 or so things that when we were all talking about what we wanted to cover today came up as some classic patterns that can come up and cause some risks actually during Series A in particular. Those were things like business models still being pretty fluid, even during that capital raise, or perhaps customer validation is based on verbal acceptances rather than anything written or formalized. Obviously, regulatory and permitting risk being treated as something we can get to later, or timelines that assume a best case execution rather than reality. So if we could pick up on 4 of those, and Tom, don't you worry, we are going to come to you after we've looked into this, because I think it'll be interesting to hear about how you tackled some of these areas that have been stumbling blocks for some companies in the past. But Jeff, could you maybe take on this kind of typical stumbling block of business models still being somewhat fluid? Like, tell us a bit about what you've seen there, and how do you work with people when that is, something that you're sensing?
Well, as usual, Alex, I think I'll argue with you a little bit and frame that I think the balance between a necessary amount of fluidity and flexibility is vital while still having a directionality. And what I mean in particular is so many of the groups that we work with, the companies we're trying to kind of, or I guess the visions that we're trying to turn into companies, depend on not just Series A, but on multiple iterations of capital. And I think a lot of our founders get very focused on the mission and the end goal of where they want to be and where the entity is going to be thriving in 5 years. And occasionally that comes at the expense of not amending and adapting that business plan to those increments of capital. And so one of the things that we, in terms of defining Series A, or really any round, is to have very clear, defined milestones that in many ways are informed by what the next layer of capital needs to see in order to be unlocked. I think in some instances that is a pilot phase that produces a result that can be evaluated and tested. In some cases that's getting to even the most basic level of revenue. In some cases that's getting to some of the other things I think we're going to touch on in this segment. But looking around the corner and seeing where the next pocket is going to live, and then having that rotate back and help to drive decision making, that type of fluidity I think is of critical importance. I think we're also, where the way to combat the fluidity and unknowns, I think, as Brian touched on in a political context, is to have a sense of how your business operates in a variety of circumstances, kind of defining that out at the top so that you're able, as those types of conditions change, to kind of navigate and have more of a consistent business plan through a variety of cycles. So I think there's two sides of that coin, and it's about having, and I think this is where having informed inside outside advisors, people who have perspective and are maybe not quite at the founder level, but are deeply embedded within the organization, to kind of frame that balance and make sure that we're talking and managing both that consistency of what we're trying to accomplish and the flexibility to adapt along the way to get there.
Yeah, I mean, that also relies on this next point, doesn't it? Which is really understanding what customers need first, and not just understanding your technology or what your kit and what it does for someone. It's like, what does a customer really need? And I wonder, Brian, if you could talk a little to that kind of customer validation piece. I'm always a little surprised when we hear earlier stage tech companies talking in very loose terms sometimes about what they perceive as the market need or opportunity. What are you seeing, and what's the kind of advice or the work that you do with people on that?
Yeah, and this is something that Jeff and I think is really paramount for any company that's looking to advance to a commercial stage. It is really critical to kind of get this embedded early on as an adoption, and something we kind of preach to when we see something for the first time. This is one of the top things on the list that we try to highlight, and be curious, ultimately as we talk through here, to get Tom's thoughts, kind of boots on the ground of this. But something we've talked about at your events, Alex, in the past, about the work in the lab versus stepping outside into the sunlight, is one of the best ways to kind of describe it. Is getting that commercial or even strategic partner adoption of what you're doing, your product or service. There's we're enterprising people, or we're market focused. We support new ideas and the geniuses behind them, but sometimes there's an avoidance of stepping out, if you're a new company or a new enterprise, to get that adoption, for a lot of reasons. And sometimes it's just, kind of emotional or mental. But really, stepping out can cause, some scrapes and bruises, and you can get feedback that you're not really ready to hear. But that is really important, because if you believe that you have something that, as Jeff said earlier on, is needed, and something that has to be built and has to be produced or has to be persisted, then that's really important to know that early, and to know how that adoption in the marketplace will be received. In addition to that, on a positive note, getting that commercial adoption from someone, hopefully with in written form, is also critical to getting capital, right? So as Tom can probably attest to, it's very, very difficult. Not impossible, but very difficult and challenging to get capital if you don't have, hey, these are whom I'm going to work with as I round the track across the finish line. And someone can see that someone's ready to kind of take, as I would say, take the baton. That buy-in is really critical. Getting non-binding commitments from the other side, so neither side is overly or under committed. But raising prematurely prior to that, you can kind of test the waters. We always say all marketing is test marketing, but ultimately you really need that commercial adoption from a partner that will be supportive and validate your business as you move forward. So getting that doesn't cost any capital, as we say. You don't need money necessarily, or funding to go out and speak with those potential companies and partners. Sometimes people have it backwards, where they need capital or ask for capital in advance of that. But we think it's actually necessary to get that adoption and support prior to that, to move forward.
Yeah, I think one of the interesting things we on the Decarb team have seen in the last, I would say, 6 or 9 months, is actually a renewed wave of interest in some of the much earlier technologies from amongst our industrial clients as well. So that's promising, I think, if you are on that research and discovery phase, is that I do think there are more open doors to knock on, whereas for a while it felt like people were sort of almost saying, no, early stage stuff we're beyond, but actually that does seem to have shifted. Jeff, let me come back to you. Something that comes up every event that we do, not only in the US, but particularly in the US and Canada as well, is regulatory and permitting risk. Actually, it probably comes up more in North America because there have been more projects. That's probably the reality of it. But again, how can you work with earlier stage businesses on that? Because understanding the regulatory realities of different states or regions or provinces or I mean, it's a full-time job for big government consultancies, isn't it? So how do you work with companies to get the information they need to therefore get the funding round they need?
I mean, it's one of the most challenging parts of the role, right? So much of what we need to do, as we put a kind of capital raising lens on, is tell a story more than anything. And this is one of the most foundational aspects of the story, and a place where we can make or break ourselves, not even with whether or not we can successfully navigate a regulatory environment, whether we can achieve permits, but on the front end, if we can speak and inform about what we need to do to gain those approvals, right? Part of that storytelling is having such a command and control opportunity around that pathway. Who are the players? Why are they either opposed or interested? What aspects? I mean, one of the things that we've tried to do in a number of circumstances is, to the extent that we can leverage existing businesses, existing strategic partners, and in particular, kind of existing permit environments, so that when we're coming to a state or we're coming to a county, we're working with people who are already familiar with kind of our partners. They know the site, they know the area well. That can be worth its weight in gold in navigating. And I think getting us connected to the right people, so that when we're then cycling it forward on the capital side, we're referencing the exact pathway. I mean, much of the capital we're seeking at an A stage in particular is going to be to fund that pathway. And so having the risk mindset, I said at the top, right, nobody wants to invest this capital. This is not money that is typically seeking homes. We're really trying to convince our capital partners why this is viable and exciting, and why ultimately this will drive and deliver a company, and not just a project, and not just an exciting opportunity. Putting that risk mindset on is the way we differentiate, right? Leading first with an understanding of their risk tolerance and their understanding of the risk environment is critical. And I think this is the area for many capital partners where it's the biggest black hole and the biggest fear of, I can have everything in my favor. The commercialization of the project can be stronger than ever, and I'm going to be trapped by something completely out of my control that's a black hole of expense that I have no clue how to navigate through. They're relying on us to at least tell them the questions they need to ask at the outset, and that command of those questions, that command of that environment, then gives confidence that we can effectuate the outcome. I've worked with a lot of groups where we, as kind of a partner, have that confidence. Evidencing that to the market, evidencing that to capital is a more challenging endeavor. But if we can't do that piece, then the actual ability to deliver on it is we'll never actually get to that stage. So that storytelling element becomes so important.
I guess before I come to Tom, the kind of the final area that we cherry picked, I guess, because there are other things we could talk about too, as being classic areas where things either go well or can really count against you, is this timelines issue. And people wanting, as part of the narrative, to present that best case scenario. But obviously, if timelines start drifting, then that's a problem for everyone. So again, Brian, back to you for thoughts on that.
Yeah, planning on a timeline, I'm going to say what sounds obvious, but you'd be surprised on how much we see that's not what we call linear. And I guess from, by definition, a timeline would be linear, but unfortunately, we see somewhat of a disparate approach to moving forward, where if I have a lot of irons in the fire and I have a lot of rabbits I'm chasing, that ultimately I'm going to get to where I need to be because I need to have as many kind of chips on the table, where a linear timeline, and as Jeff said earlier, you can be fluid and you need to be fluid and flexible and kind of stick and move. But sometimes people feel like they're boxed in, especially if you're a genius business owner and you've got a very creative mind and you're thinking of a lot of things at one time. Sometimes it's difficult to think in kind of one path. But that is the path that we see to success. We see very few times where you have multiple paths concurrently happening, like a multiverse, as we would say, and you get to a successful end game for that. The team needs to understand that a timeline can be a number of things that can be problematic. It could be too aggressive, where it's just too short, quite frankly, or you're underassuming how much capital is needed. The milestones, this is something that we see a lot, that they're too far and unreachable at any given point. So I'm starting today, as we talked about, the lab phase, and then I'm going to have a commercial facility or service in a year. Well, there's a lot of steps in between there. And if you need capital to reach the ultimate goal, obviously in Series A, B, or C, or pre-seed, then you need to break that down into more digestible goals and milestones. So that's something that we'll work with teams to identify. Well, if A to B, and B is the ultimate goal, maybe it's A1, 2, 3, and 4 that need to be measured. How much capital to get to each step, and then what's accomplished at each step, so that capital can have visible milestones that they can see towards where that the business is moving ahead and it's increasing in valuation and purpose. So communicating that to capital is really critical, because ultimately when you're raising capital and you can show a timeline, capital, obviously they're going to want to see some tangible results of their funding coming in, and then ultimately coming back to them in some sort of a return, whether it's a yield or a multiple on their return. And you can only do that if you can show that the business progresses forward, and here's how it does on each step of the staircase. So if that timeline needs to change, if, as Jeff was pointing out, permitting extensions, which always happens, market conditions, unforeseen circumstances, having a plan B and plan C is critical. But that plan B and plan C ultimately has to be another rail you're going down, and not multiple rails. So that's really important, and something we try to instill in our client partners very, very early on. Non-directional plans just really don't work, period. And kind of getting that mindset.
Okay, well, thank you both for that. So I'm going to come to you now, Tom, as the person who's actually had to do the real work here. You're part of a team that has obviously built something from scratch. You've heard, and I'm sure there are many more things we could talk about, but you've heard those areas that are often common tripping hazards for companies. What was your experience, either of any of those points, or areas that were maybe the hardest areas of learning for you when you were going through that prep phase ahead of your funding round? What can you bring to the table?
Yeah, thanks, Alex. I fully subscribe and validate a lot of Jeff's and Brian's comments, and we lived a lot of them. Capture 6, when we started preparing for our Series A in 2023, and then we launched it in early 2024, right as the market was kind of coming out of the green boom and into what is now fundamentally a very different political and investment climate. And over the course of that, focus shifted pretty dramatically. And I think what in retrospect we would almost describe as like quasi-science fiction solutions now require, at that stage, required a lot more validation and a lot further progress. I would say for Capture 6, while that was painful at the time, the shift was actually very good for us in the long run. The pressure from investors, which is entirely fair, to show contracts and customers was really forced us to hone in on our true value proposition. and move away from our technology to the problem that we were trying to solve. And I would say that was introduced right at the start. The faster that founders or technologists can get out of their own sort of technology and into discussions with customers who have real valid pain points, the better off you're going to be for the long run. That's not to say that technology can't be ambitious, but just keeping that in mind that the milestones you need to meet in order to raise capital are probably sooner than you think. So you don't necessarily have to wait for, and you actively should not wait for a perfect solution before starting to try or starting down the path of commercialization.
Yeah, I think that point about, that you won't have the perfect answer all the time is exactly right, because it also comes back to that sense that we're iterating not just technology, but also narrative, and the customer base can change and all sorts of things. So that's really helpful. Thank you, Tom. So and this is kind of an open season to the three of you. Clearly, leadership teams are make or break it. The technology matters. Clearly, the technology matters. But when you talk to the investors at our tech investor event or elsewhere, it really is the leadership team that it kind of drives most decisions. So what is it that the strongest leadership teams do differently? And a slightly different angle, but same question to Tom. What did your leadership team, what did you and the fellow leadership team learn to do or need to do that helped you stand out? So maybe I will come to Brian, first of all, with that one.
I think that again, and I think Tom's company, I think Capture Six is a great example of this. So curious to get his thoughts on this, but solving a problem, fulfilling a need in the market, where I think the last year or two in the US has been evident of this. We do work with a company that we've co-founded that's in the recycled fuel space. So it's taking waste and creating fuel. And we were up against kind of the renewable and biofuel space in the US over the last several years, up until the political climate changed. And a lot of those subsidies went away and those companies weren't economically viable. That I think showed that a lot of those projects, not all of them, but a lot of those projects weren't maybe necessary. That, hey, I can take this and make this fuel. It's sustainable, but it questioned whether it was really needed. Whereas what we're trying to support through our co-founded company is really cleaning the environment of waste and then also making a good product on the back end. And I think Tom's company is a great example of that, of fulfilling a real need and solving a problem that industrials and strategics maybe can't do on their own, or just it's too timely and cost ineffective to do on their own. So they need a partner like a Capture Six to come in and solve that problem.
Jeff, do you want to jump in with again, this is on the thoughts on what is it that the strongest leadership teams do differently, or the teams you're working with need to step up to?
Yeah, I'll try not to speak to the and chastise any of our partners. I think one of the things that we focus a lot on is kind of two sides of the same coin from my perspective is self-awareness of who we are and where our talents lies. I think for Brian and I, we're very quick to admit a staggering lack of talent around technology creation, idea generation, engineering is something we're quick to admit a real lack of knowledge around. And so we have balanced that by being aware of those shortcomings, balance that with partners who have exceptional technology experience, deep engineering background, right? If we know what we're missing, we can look to bring that in. And then I think kind of part and parcel with that is strong teams have strong partners that, again, kind of serve that inside-outside role, whether that's advisors at the board level, whether that's kind of folks who, if we're thinking about a Series A round that maybe haven't come over full time but are deeply aware of the market, whether that's a partner, on the kind of financial advisory side, but folks who have a independent perspective that are deeply committed to the mission and to the goals of the organization, but can point out and identify where those weaknesses lie. And in particular, as we're thinking about a capital raising context, take the other side and point out what the risks are. I think so much of our coaching is trying to keep founders as enthusiastic and optimistic and as entrenched in their belief in the viability and the success of their organization. You need that enthusiasm to successfully raise capital. That, to your point, Alex, people invest in teams, not ideas. That passion and command and just concrete belief in what we're doing is critical to raising capital, as is knowing what could go wrong and what the risks are. And it's a challenging effort, I think, for some founders to straddle both sides of that experience. And so having partners who can, in a respectful, kind, and helpful way, take the other side, point out, well, this could go wrong, this price could go higher, this subsidy could evaporate. How do we think, how do we manage through those circumstances? Living that duality, I think, is critical. And to me, you have to be self-aware if you're not able to straddle that line. You have to be self-aware if you're not able to fill those gaps on your own. How to identify them first and foremost, then filling them, I think, is the easy part.
I think that piece that you just mentioned of finding the right partners who can help with that continual motivation, as well as being able to identify risk. No one would launch a business if you actually knew how hard it was going to be at every stage. There are just other ways to enjoy your life. But so you need a little bit of willful denial.
Somebody pointing out every reason not to invest, you need that unshakable belief to weather that. But I think you also need to kind of know going in what those fear factors are going to be to be able to answer the question.
Yeah. And one of our sessions, no, actually, it was another event I attended last year. There was also this interesting point about that getting those excellent expert partners in just so much earlier. And in this case, it was about EPCs, because the guy was saying, most people underestimate by 15%, then 20%, and then 30% at each round what the real cost is. And he said, I might not have built your tech before, but I can tell you what the margin of error is, in those things. So I thought that was interesting. Tom, let me come to you. So how did you, was the leadership team that you are now, is that what was in place before you began your funding round? Like how have you approached this from a leadership team aspect?
Yeah, I think we have been pretty consistent at the leadership level since prior to the round through to today. I would also echo what Brian and Jeff have said, and then add another element that I think is important for founders or early stage companies to go through. And Capture 6 could have benefited from this, more of this, let's say, but scenario planning for a variety of different eventualities and some tough ones as well. And I think thinking back to 2023, 2022, there was this huge policy-led fundamental force or enthusiasm for carbon and decarbonization, and really testing that assumption would continue to hold, I think would have served not only Capture 6, but a lot of other companies much better. I think the solution that we came upon and we sort of adopted early on, not necessarily realizing the potential of it, but was diversification of the opportunity set. We did not put all of our eggs in any one single basket in terms of commercial opportunities or individual partners or advisors, or even to a certain extent, certain technology choices. And I think that has paid itself back time and time again. Project development, I think, Brian, you mentioned this, it's just not a linear process. you have to plan on a linear way, but you have to be prepared for different scenarios and different contingencies. And what we've seen is that, we're kind of maintaining a project portfolio of 4 to 5 active projects, and that can change. And it's important not to hold on to any one too dearly, but they just move at different paces, and you can apply lessons from one context to others much more rapidly if you're iterating at the same time rather than learning one set of lessons and then succeeding or failing and then learning a new set of lessons. And I think that was pretty critical to our success during this transition.
Okay, well, look, in the interest of time, because I want to make sure that we do get to our questions as well, I'm going to move on to something that really, we all kind of mentioned at some point here, which is early costing and planning. And I'm curious to hear from Jeff and from Brian, like, what are you seeing about where costs are really killing, inhibiting credibility when it comes to funding rounds?
I mean, I think the biggest challenge we all face, it's natural, is to struggle to really define how much we need at each stage. I think you've heard Tom, you've heard Brian, you've heard me kind of all talk about the uncertainty planning that we're trying to do. And in many cases, we're trying to uncertainty plan for things that we haven't even thought through, even with kind of a fulsome, what could go wrong process. And so the sizing of the raise in terms of an unknown timeline is the biggest challenge. That to me is the larger cost, if you will, is time more than unforeseen, more than inflation, particularly at the early stage. When we're getting to actual EPC build, then obviously we're talking much more about kind of those input costs. But in the initial couple rounds, we're looking far more at an uncertain time horizon and pathway forward. We're trying to manage risks that we really are hard to define at this stage, and so sizing that becomes most important. I think that's where to combat that, the focus needs to be on, as I said at the top, what milestone do I have to achieve to get to the next round? I think in a lot of cases for us, the question becomes, when is strategic capital going to become available? Is that in the Series A round, kind of through a commercial relationship? Is that after a few iterations and we've demonstrated something and getting to a B round? But thinking about the strategic element of market evidence, so much of the capital we're talking to really is at a disadvantage in understanding what we're actually trying to do, what this problem we're trying to solve is. In a lot of cases, we're trying to explain that the problem exists and demonstrate that the urgency of that problem, and then how we're going to solve it. That's a lot of explaining to do in a short conversation. And so for us, orienting around when the right strategic partners will come on board helps to break that down. In other words, if I can help show strategic support, then I can really demonstrate to somebody who doesn't understand these markets, those that do and are in that space, their understanding of what we're doing. So I think orienting to those milestones, then I think makes it easier to define how much we need, how we can manage through uncertain cost environments.
Alex, I 100% on what Jeff said. I think I'm going to go out on a limb and say this may be one of the things that stops early stage companies from moving forward. And it's the lack of awareness or self-awareness, or the refusal to accept maybe reality. And this is an emotional thing. This is a tough thing. And that kind of on what Jeff said and to what Tom said earlier, along the way, always asking yourself this question: are you sure? Are you sure this is what this is going to cost? Are you sure that the cost will get you where you need to go? Are you sure I do or don't need to work with this strategic? And it's not all about cost, but a lot of it is. And a lot of where we see things stumble is that things cost 2 to 3, 5 times more than they actually originally thought, or things take much longer, which equates to cost, right? So that this is it could be a really kind of cancerous type of thing that comes in early, and that you really have to be self-aware. It's a really tough thing that if you have conviction in a product or service that you've developed homegrown, to say, I'm not sure this is going to work, or I'm not sure it's going to work, and ultimately lead to, which is the reality, has to lead to some sort of cash flow for that capital. It can't always be kind of negative cash flow and kind of a nice idea. It ultimately has to be a viable economic standalone type of idea and process. And this is why we applaud Tom and his company to, having navigated these waters, which is extremely difficult, but very early on being aware and really getting the best information you possibly can, as kind of Jeff was alluding to, and determining when it makes sense to partner with other companies, which could, de-risk your situation substantially and maybe even bring costs down, or they can contribute capital. But knowing that early, and just being able to accept reality, and trying to fight through it if you can, is really, really critical. This is something, unfortunately, that we see that really stops things in their tracks. And the ones that get through it, as Tom said, that you have plan Bs, plan Cs to work around it and ultimately achieve what you need to, and to navigate around that. But if it's a singular idea and it's just not economically viable, it's something that needs to be determined early on.
Yeah, I would just add one point, which is, I think, kind of reinforcing a lot that's already been said, but just framing it a little bit differently. I would say, arguably, in a lot of ways, the most important thing is to get concrete and steel into the ground as fast as possible, and get out of the lab as fast as possible and into actual industrial demonstrations. I would say, that the data that you get from those types of projects is much more credible than a deck or even a bench scale system.
Agreed.
Because you learn a lot in that process, and it can be very humbling, admittedly, and it does force you to rethink your technology stack and your cost structure, but it will give you a lot more insight and a lot more intelligence for how to have these conversations with investors going forward.
I agree. I think it's why, as Alex said earlier, why a lot of people don't start companies, because it's painful, and to be able to do it. In starting our own business, we've had to navigate these type of things a little bit differently, but it's tough. It's really difficult. You learn a lot, and I think you hit the nail on the head, Tom, that you learn from those internal, I don't want to say mistakes, but challenges the best, and really that's how, necessity is the mother of invention of moving forward.
Tom, before we move to the questions that we have, and I'll also just use this as an opportunity to encourage any more, I'm just thinking about, the learning curve, no matter how strong and how well informed a leadership team, there's got to be, a big learning curve going through a Series A. I'm curious about like the mental model you have now about fundraising versus what it was a couple of years ago. Is what in particular has changed for you? If you were, or another way, if you were starting that process now, is there something you would have done first differently in a different order?
I come from more of I come from a finance background and more of a debt investor background. And so I've always been cautious almost to a fault and conservative almost to a fault. So I'm coming at this from probably the opposite of a typical, founder-led entrepreneur who's raising capital. For me, it was a challenge to sort of focus on the upside potential. But I think more importantly for the question, I would say we completely pulled out any policy incentives from under our underlying pricing model over the course of the last few years. And fortunately, our technology solves real world problems for which customers are willing to pay. But that sort of forced us to really understand where the technology was viable and where it was not. Now, policy mechanisms can be really fantastic and really supportive, but making sure that the core case is sort of fundable without, an emerging voluntary market or the continuation of a very supportive policy regime, I think is something that all entrepreneurs and all technology teams should test themselves before going to market.
Great, thank you. So let me then dive into some of these questions, and thank you to everyone who's put something in here. So in no particular order, but this one just jumped out at me, and really just dive in if you have a contribution here. How do you get on the front foot when a sector is declining? And I guess we're really talking about the kind of decrease in speed to capital that's happening at the moment. So how do you get on the front foot when reaching out to investors who are seeing, whether it's plant closures or stalling projects or so forth? What's the approach there that can get you in the door?
I'll be brief and hand it over to my colleagues here. But I think it's going back and just being realistic about, is this viable, right? If the industry is declining, let's not be the emperor without any clothes on. Let's be realistic about, is this necessary? Sometimes great opportunities are born in industries that you're kind of being contrarian. But I think that causes even the more critical need for commercial and strategic partners to buy in, and someone that's going to tow you along and say, I know this seems to be in decline, but I am working with these companies who would like to partner as we move forward. Then I think that kind of lifeboat is almost necessary in that case. But I'd be curious what my colleague said.
Yeah, I mean, I always think of, look, Uber to me is probably the example of the opposite of this, of driving an outcome to truly kind of change the way people think about things. I think by and large, most of what we deal with is really more trying to evidence the problem that we're solving and the viability of how we're solving it. And I think for us, I think Brian was getting to this as well. Having the market participants in the space demonstrate that urgency for us demonstrates investor urgency. Like we've had a lot of things that haven't worked out. One of the ones that didn't work out, I think meaningfully, was a project we really believed in. I think it was one of the best teams that we've worked with. It was extremely well thought out. This was in, kind of grid scale energy storage. And we had a lot of trouble getting a utility partner to lean in on the commercialization side. And that lack of urgency felt by the utility landscape. We were in the right location with the most potential partners kind of geographically that we could access. And without their willingness to step up to the plate and say, we really need a grid scale storage solution, made it really hard for us to then turn around and kind of jump up and down and scream at capital that we really need to invest in this. This is something that is going to happen. The only barrier to this being successful is capital. That the kind of flip side, if we're able to demonstrate that urgency in the marketplace, then it becomes very easy to be a storyteller of, we've done this, we're going to do this, we're going to do this. The only barrier to success, and this is how we always want to frame the story, the only limiting factor at the moment is capital. I think there was an article in the journal yesterday about some of the AI startups getting an anchor to their seed round and then dramatically increasing the valuation that they're raising at. And you can argue whether that's legitimate or not, but there is some element of, if we can frame it correctly, that the only limiting factor is capital, then when some capital comes in, we have de-risked and there is an uptick in valuation, right? There is a logic to that. And that's how we want to position the story. But to do that, we need to kind of show market urgency. Again, as I said, to people who don't know, and certainly aren't, in most cases, aren't feeling that the urgency of that problem in their day-to-day lives.
Okay. Tom, I'm going to come to you with a question that's been earmarked for you. So our anonymous, who has been busy in the Q&A, says, it looks like grant funding provided a lot of support as you built out the project pipeline. How did you go from this to building the conviction to progress to FID on those facilities and getting steel in the ground quickly?
Yeah, I think non-dilutive capital or concessionary capital has to be part of the strategy for any company. It helps, that there are different pools of capital available to solve different public challenges. And I think framing your technology around those can be very helpful in driving things forward. I think for Capture 6, what we realized was that there was quite a bit of support for water and water-related initiatives, and that just validated the shift that we went through from 2022 to 2023 and 4 and all the way to today, that there is a challenge around water that can be supported with our technology, and that carbon markets can help support that challenge as well, and that they're an integrated sort of problem. So I think for any company out there, you should be looking for concessionary capital, and that does help validate the idea of a market need. But ultimately, I think this is probably the kernel of the question. Each of the projects that we're pushing forward is also underpinned by an actual customer's need. So matching those up, I think, is critical. Now, grants without a customer need are great, but I think they can become really impactful for project development purposes when they help push you forward, not only through the technology phase or the demonstration phase, excuse me, but to the FID on a commercial scale phase.
This is just a small kind of question to you just to build off that. Are you seeing more of that grant availability, whether it's public grants or philanthropic grants? We sort of have this sense from our side that we are seeing more of those, particularly from the private, philanthropic market coming through. What are you seeing?
Yeah, I think the pullback of some of the carbon-focused support from the United States, I think, has been to a lot of different stakeholders' credits kind of compensated for with other sources of capital. And I think just going back to the diversification point earlier, I think the shift out of some of the Biden era policies and mechanisms is clearly being compensated for here in Europe, with a lot of fantastic policy related support and funding sources from the EU and Germany and other national governments and elsewhere in the world as well, the Middle East, Australia. Now, that's all great. I think going back to the earlier portion of the conversation, you still have to make sure that your technology is grounded in real world problems that you're solving with real customers today, and technology that can be deployed today, rather than something that will magically emerge in 10 years. When you can find the grants that support those challenges, that's where you really can accelerate your business.
People will pay to get a problem solved. They just, in most cases, they will. I saw some other questions that, if it's something that needs to be deployed for solving a problem and someone needs to find a way to get an answer, capital tends to flow towards that.
So from the question list, let me pick up on one, which I think, we hear a little bit about, which is with dynamics shifting in policy, politics and funding, how would investors respond to a US-based Series A company chasing funding in Europe? Is that a red flag for lack of focus, or is it a pragmatic decision? What guidance, I guess this is more Jeff, Brian, from you, what guidance would you give?
I mean, I think the mission-oriented capital is more overseas than it is domestic in the US at this point. The willingness to lean in a little harder and maybe take a kind of known but smaller return, with the knowledge that this is driving a real carbon outcome, is easier to find partners in Europe and other points around the globe than it is in the US. I think the flip side is projects that have an economic thesis independent of credit, that can see subsidy, credit, commercial benefit from those policies either restoring or continuing. If that's accretion to the equity in addition to a kind of a base return, then I think there's a real appetite, kind of in the lower 48 for those type of opportunities. If it's more of that, kind of leaning in on, we have a partner that relies upon voluntary credits for methane abatement, is effectively pre-selling the credit on a voluntary market in order to pay for ongoing work. Those credits are largely being sold, and that capital is coming from overseas. On the flip side, the businesses that have, kind of a baseline economic problem-solving thesis here are finding that capital internally.
Yeah, I agree 100% with what Jeff said. I think, at the end of the day, if it's an investor, an investment firm, they're looking for return ultimately, maybe obviously to do social good, but if that can be, somewhat agnostic to region, so someone in the UK may be very interested in something in the US, and especially if you kind of prove the viability of it. So I'm saying that you should just chase all over the world for capital, but investors all around the world are have a lot of one thing in common, and they're trying to make returns. And you can prove that with something that's viable in the U.S. Then to someone that's overseas, then you should certainly try. I think maybe I'll mute.
Apologies. Final question, and then I'll come to each of you for final comments. And I'll come to you, Tom, first on this. This is a question from someone who's talking about this idea of proof and being able to bring the right kind of self-awareness, proof, and so forth to the discussions. So what is a good indicator to show that numbers and assumptions are valid and achievable? So when you think about that, what is it that they need to show, or what source do they need to come from? What was your experience there, Tom? And just a short answer, if I may.
Yeah, sure. As much as possible from real world applications that you have delivered on, that I think is the standard. From a technology risk perspective, we have tried to incorporate standardized components that are widely used today, so that we don't have to prove that, a reverse osmosis unit works. And I think that works for a lot of investors, but they still want to see it all integrated together in a way that the management team and the project team have delivered yourselves.
Okay. Well, thank you for that. And let me, as I say, just interested in each of your kind of final comments, and maybe for Brian and Jeff, could you give a couple of the key takeaways for tech investors or others? And Tom, a couple of takeaways just from your experience, like what would you advise, what would you be encouraging to the tech sector to do? And I'll start with you, Tom, and close out with Brian and Jeff.
I think there have been some amazing insights here today from Brian and Jeff, so thanks for allowing us to participate today. But I would say just a key takeaway is that the projects, from our perspective and our experience, the projects that get funded aren't the ones with the most ambitious technology or the ones with the longest term benefits. They're the ones that can be delivered today and that solve challenges today. That's not to say or put a brake on ambition and to think about the future, but you've got to start with something that can be delivered today and is realizable today, because Brian and Jeff both mentioned it, investors want returns as fast as possible.
Yeah, if I could piggyback off of that and take it one step further, I think Brian was alluding to this earlier. We need to, as management teams, do one thing and execute on that fully, and then move on to the next. And part of maintaining that ambition in the right form is having a very clear sense of what the next task is and being solely focused on that execution, and then moving on to the next. When we try to do everything all at the same time, we get nothing done. I think I know Brian and I are both prone to that. I would assume a lot of people here are. Having that kind of laser focus on one thing at a time is our, overriding ethos.
Yeah, on that, if I could, Alex, highlight a billboard, if I would, takeaways from today would be stay practical, stay focused, stay positive. Because I think that kind of like clipped some of the things that Jeff and Tom said very, very well. All those things are necessary, and getting support. And I acknowledge there's some other questions we maybe didn't get to on the chat here that we would open people to contact us offline about those through LinkedIn or otherwise, make our contact information available. But we're happy to talk more about these things. We live and breathe it every day, like Tom does, and we really enjoy what we do. We're really blessed to be part of this whole ecosystem and working with Alex, you and your team. So thanks for the opportunity, and look forward to continuing to try to help others out here.
Well, thank you all. And Tom, thanks for bringing your experience of that round and what life has been like at Capture 6 to this. And Brian and Jeff, thank you very much for lots of good inputs here today. We will now pass back to Jack, and welcome to close out, Jack.
Yes, thank you, Alex, and thank you once again to all the speakers here today. It was a fantastic presentation and conversation throughout this hour. Yeah, so we'll be sharing a recording of today's conversation. So it will be with you next week. So please do keep an eye out for that. And please do email me at jack@decarbconnect.com if you've got any specific questions around the presentation itself. I can always direct you to PhiCap or to Tom. But also, if you've got any questions about how you can get involved in our ecosystem here at Decarb Connect, whether it be a webinar or at our community or at some of our events, we're always keen to chat and to connect the dots across our wide ecosystem. So yeah, thank you once again, and I hope you will have a good rest of your day. Take care.